Ever find yourself looking at a company's financial reports and, well, wondering if the numbers you see truly paint an accurate picture?
That's a common question.
Today, we're diving deep into the world of financial audits to explore a really crucial aspect of that: how auditors handle mistakes.
Or what they formally call misstatements.
Exactly, misstatements.
Yeah.
Our guide for this journey is International Standard on Auditing 450, or ISA 450.
Right, titled Evaluation of Misstatements Identified During the Audit.
Think of it as the auditor's playbook, really, for navigating errors big or small.
All to make sure those financial statements you might be relying on offer a genuine view.
And understanding this process is key for anyone wanting to grasp the reliability of financial info, right?
Absolutely. An audit isn't just a checklist exercise. It's about forming a well-reasoned opinion.
Okay.
And ISA 450 provides that necessary structure for auditors when they uncover discrepancies.
So if it guides what happens after they find something.
Precisely. It's about the crucial steps that follow and what those errors ultimately mean for the bigger picture, the company's financial health.
Yeah, this isn't just insider baseball for auditors. I think the principles in ISA 450 offer valuable insights for anyone who wants to understand, well, the robustness of financial accountability.
Agreed.
We're going to try and unpack how auditors approach these potential inaccuracies today. Give everyone a bit of a behind-the-scenes look at the mechanisms designed to make those reports dependable.
Okay, so maybe just to set the stage a bit.
Please.
ISA 450 gives a clear framework for how auditors should systematically deal with misstatements they find. This applies to audits of financial statements for periods starting on or after December 15th, 2009.
Right, so it's been around a while.
It has. And it outlines their core responsibilities, how they gather and track these misstatements, how they evaluate their significance, and importantly, how they communicate their findings.
And the potential impact, too.
Yes, the impact on both the audit itself and the financial statements.
Okay, so our goal in this deep dive is really to get to the heart of ISA 450, make its core principles clear and relevant for our listeners.
Make it understandable.
Yeah, we want you to come away with a solid understanding of how auditors decide what's a minor issue versus something serious, something that could distort the financial picture.
And how they communicate those judgments. That's key.
Definitely. Okay, to kick things off, let's start with the basics. According to ISA 450, what exactly is a misstatement?
Well, the standard gives a very specific definition. A misstatement is basically any difference between what's actually reported in the financial statements.
Okay.
That could be a specific dollar amount, or how something is classified, the way it's presented, maybe even the information disclosed in the footnotes.
Right.
A difference between that and what should have been reported according to the applicable financial reporting framework.
So any deviation from the, let's say, accurate financial reality.
That's a good way to put it. Any deviation.
Right, so it's not just about getting the numbers wrong. It could be putting info in the wrong place or maybe not being transparent enough in the details.
Exactly. And the standard points out these misstatements can arise from a couple of different places.
Okay, like what?
Well, they can happen unintentionally. Simple human errors in calculation, oversights, maybe misunderstanding accounting rules. That's error.
Just mistakes.
Just mistakes. But they can also be intentional. And this is where it gets more serious. They could result from fraud, deliberate actions taken to misrepresent a company's financial position.
And I imagine the auditor's response changes depending on which it is. Error versus fraud.
Oh, absolutely. The response path can be quite different.
That makes a big difference.
Yeah.
And the definition also mentions uncorrected misstatements. What does that term refer to?
Good point. Uncorrected misstatements are simply those that the auditor has found and recorded during the audit,
Okay.
but that the company's management hasn't actually corrected by the time the audit is wrapping up.
So they're the ones left over at the end.
Pretty much. And these are the key items the auditor really needs to assess to figure out their impact on the fairness of the financial statements and ultimately the audit opinion.
Okay, so auditors are keeping this running tally as they go, but I can't imagine they're noting down absolutely every tiny discrepancy, like down to the last penny.
Yeah.
Seems inefficient.
You've hit on a practical point there. ISA 450 definitely recognizes this. Auditors are required to accumulate all misstatements they identify.
All of them.
Well, all of them except for those that are deemed clearly trivial.
Clearly trivial. Okay.
So there's a practical exception. It implies there's a threshold, probably a low one, below which an error is just considered so insignificant that formally tracking it isn't really necessary.
How do they define clearly trivial? That sounds like it could be a bit subjective.
It does involve professional judgment, definitely.
Yeah.
But the standard clarifies that clearly trivial means matters that are, well, undeniably inconsequential,
Inconsequential.
both on their own and when you add them all up. And importantly, you assess this without considering any other factors. It's about pure insignificance.
So just the amount.
Primarily, yes. Auditors often set a very low monetary threshold to help identify what falls into this category, like maybe anything under $100 or some small figure relative to the company size.
But what if it's a small dollar amount, but it seems like it might be a symptom of a bigger problem? Would that still be clearly trivial?
No, precisely. That wouldn't be clearly trivial. And this is where it gets interesting.
Okay.
As the audit progresses and these misstatements start to,
Our
accumulate.
list gets longer.
Right. The auditor isn't just adding up the dollars. They have to keep a broader perspective. The standard really emphasizes considering not just the amount of the misstatement, but also its nature and, crucially, its underlying cause.
Why is the cause so critical?
Because the cause tells you a lot. It can indicate if it's just an isolated one-off mistake, a simple slip-up maybe, or if it suggests something more systemic, like weaknesses in the company's internal controls or even potentially fraudulent activity.
I see. So a pattern of small errors from a bad control could be worse than one big accidental error.
Potentially, yes. It could be far more concerning than a single larger misstatement that seems like an isolated incident.
That makes perfect sense. Looking for patterns, not just the dots. And what about the total amount accumulated? How does that factor in?
Well, the standard highlights that as the total of these accumulated misstatements grows, it starts getting closer to the materiality level.
Materiality, the big threshold.
Exactly. The level that was set back in the planning stage. The point at which a misstatement, alone or combined with others, could reasonably be expected to influence the decisions of people using the financial statements.
So as a total gets near that line, the auditors get more concerned.
They need to exercise even greater scrutiny, yes, because crossing that line has major implications.
Right. And what if management seems maybe reluctant to correct even the smaller things the auditor points out?
That should definitely raise a red flag for the auditor.
Okay.
ISA 450 specifically says, if the auditor sees this management not wanting to fix identified misstatements, even ones that seem immaterial on their own, they should seriously reconsider their whole audit strategy.
Why is that?
It could suggest a lack of commitment to accurate reporting, and that, in turn, could increase the risk that there are other, bigger, undetected misstatements hiding somewhere.
So it's about the numbers, but also management's attitude towards accuracy.
Okay.
So the auditors have found these things, logged them. What's next? What do they do with this list?
The next step is quite clear in the standard. Unless there are specific legal or regulatory reasons not to,
Right.
the auditor must communicate all accumulated misstatements to the company's management. And do it on a timely basis.
Just tell them what they found.
Tell them what they found, and importantly, request that management correct these errors.
Okay. Request correction.
Yes. This open communication is fundamental. It gives management the chance to fix things.
And what if management decides not to correct all of them? That brings us back to those uncorrected misstatements you mentioned earlier.
Exactly. For any misstatements that are still uncorrected after those talks with management,
Okay.
the auditor then has another communication duty. They need to communicate these items to those charged with governance.
Meaning the board of directors or the audit committee.
Typically, yes,
Yeah.
the board or its audit committee. This communication is crucial. It should include a thorough discussion about the potential effect these uncorrected items might have on the auditor's final opinion.
So the board has to be looped in on these leftovers, even if management thinks they're okay.
That's the requirement. The board needs to be aware.
What kind of info does the auditor share with the board then?
It should be a clear summary. Detail the nature of the uncorrected misstatements, the specific amounts involved, and importantly,
Yes.
it should also include management's reasons for not making the corrections. Why did they decide to leave these errors in?
So the board gets both sides, the auditor's finding and management's reasoning.
Precisely. It ensures the board has a comprehensive picture to understand the situation.
Okay, so there's this important dialogue happening. Auditor, management, board. Now we get to a really critical point. How do auditors finally decide if these leftover uncorrected misstatements are actually significant enough to mess up their audit opinion? How do they evaluate the overall effect?
Right, this is where materiality really comes into sharp focus. It's a critical judgment call.
Okay.
The auditor has to assess whether these uncorrected misstatements are material, either individually, looking at each one on its own,
Or altogether?
or when considered together in the aggregate. And this isn't just plugging numbers into a formula, it demands significant professional judgment.
So what do they consider?
They have to weigh both the size, the quantitative aspect, the dollar amount, and the qualitative nature of the misstatement.
Qualitative nature, what does that mean?
It means looking at the context. What kind of misstatement is it? Where did it occur? What does it relate to? All considered within the specific circumstances of the company and the financial statements as a whole.
So something small in dollars could still be material if it relates to something really sensitive or important.
Absolutely. The standard makes this very clear. Even if the total dollar amount is below the numerical materiality threshold they set,
Okay.
certain qualitative factors can still make a misstatement material. For instance, maybe it affects the company's compliance with loan covenant or regulatory rules.
Oh, I see.
Or maybe it significantly impacts key financial ratios that analysts and investors watch closely.
Like earnings per share or debt to equity.
Exactly. Or maybe it distorts the reported results of a major business segment. Things like that. Things that could genuinely influence decisions people make based on those statements.
That makes a lot of sense. It's not just the final number. It's about whether the story the financials tell is accurate in all the important ways.
Yep.
What about misclassifications? Were some things in the wrong bucket, but the totals are okay? Does ISA 450 cover that?
Yes, it does. Good question. The standard explicitly says auditors must also consider misclassifications, even if they don't change the bottom line profit or total assets.
Why is that important?
Because a seemingly minor misclassification can still be misleading. Imagine, say, wrongly classifying a regular operating expense as a capital investment.
Okay.
That could skew important performance indicators, make the company look like it's investing more or generating more cash from operations than it really is. It creates a false impression.
Got it. So presentation and clarity matter too, not just the totals. And if, after all this evaluation, the auditor does conclude that the uncorrected misstatements are material, what happens then? What are the consequences?
Well, if they reach that conclusion that the uncorrected misstatements, individually or together, are material, then they have to consider the significant implications for their audit opinion.
This is where it impacts the final report card, so to speak.
Exactly. This situation will likely lead to a modified audit opinion. It won't be a clean opinion.
What kind of modified opinion?
Could be a qualified opinion. That means, except for the effects of the specific material misstatements, the financial statements are fairly presented.
Okay, so mostly okay, but with a specific problem noted.
Right. Or, in more severe cases, it could be an adverse opinion.
Adverse. That sounds bad.
It is. An adverse opinion means the misstatements are so material and pervasive that the auditor concludes the financial statements as a whole are misleading and shouldn't be relied upon at all.
Wow. Okay, that's a very serious outcome. Really highlights the weight of this whole evaluation process. Now, ISA 450 also mentions getting written representations. What are those about?
Yes, that's a standard part of wrapping up an audit. The auditor needs to get formal written statements representations from management,
Okay.
and sometimes from the board or audit committee, too. In this context, regarding misstatements, these letters include a specific confirmation from management.
What do they confirm?
They confirm in writing that management believes the effects of those uncorrected misstatements we discussed are immaterial, both individually and altogether.
So management has to formally state their position on the leftover errors.
That's right. And usually, a summary list of those specific uncorrected misstatements is included in or attached to that representation letter.
Why is that done?
Well, it serves as further evidence supporting the auditor's assessment, and it reinforces management's ultimate responsibility for the financial statements being accurate and fair.
But it doesn't let the auditor off the hook. Right, they still have to do their own work.
Oh, absolutely not. It's crucial to understand these written representations don't replace any of the other audit evidence the auditor gathered. They supplement it, they don't substitute for it.
Got it. Another piece of the puzzle. Finally, the standard talks about documentation. What records do auditors have to keep about all this?
Thorough documentation is always critical in auditing, and ISA 450 has specific requirements here. First, auditors need to document that threshold amount below which misstatements were considered clearly trivial.
The benchmark for ignoring tiny stuff.
Exactly. Documenting that ensures consistency. Makes
Yeah.
sense. What else? They also have to document all the misstatements that they identified and accumulated during the audit.
Even the ones that got corrected.
Yes, whether they were corrected or not, it provides a complete history of what was found.
Okay.
And lastly, and this is perhaps most critical, the audit file must include the auditor's final conclusion about whether the uncorrected misstatements are material, individually, or in aggregate.
Their final judgment call.
Yes, along with a clear, detailed explanation of the reasoning, the basis for that conclusion.
So they essentially have to show their work, lay out the rationale behind their professional judgment on materiality.
Precisely. This comprehensive documentation provides transparency. It supports the auditor's final opinion on the financial statements.
Okay, this has been a really insightful deep dive into the details of ISA 450. So
Yeah.
for our listeners, what's the main takeaway here?
Well, I think understanding these principles gives you a valuable window into just how rigorous and systematic the audit process aims to be,
Yeah.
especially regarding errors. It really underscores that auditing isn't just about finding mistakes, but about a thorough, thoughtful evaluation of what those mistakes mean.
Yeah, there's significance.
Exactly. You can see that even small discrepancies are supposed to be tracked and assessed for their potential impact. The ultimate goal, remember, is to provide reasonable assurance that the financial statements give a true and fair view.
This whole exploration of ISA 450 really does highlight how critical and maybe how complex that concept of materiality is in auditing.
It truly is.
And it kind of leaves us with a lingering thought, doesn't it?
Yeah.
How does an auditor consistently and effectively figure out what's material in a way that properly protects all the different people, investors, lenders, employees who rely on those financial statements?
That's the million-dollar question, isn't it? It's clearly such a nuanced judgment. It relies on balancing those quantitative thresholds we talked about with a whole range of qualitative factors.
It's not always black and white.
Rarely is. And if you, the listener, are keen to explore this further, I'd really encourage looking into real-world examples of audit opinions.
Especially ones that aren't clean.
Yes, particularly the modified ones, the qualified or adverse opinions. Dig into the reasons the auditors gave. Understanding the real-world impact of misstatements on an auditor's opinion, well, it definitely gives you a much deepened appreciation for the vital role auditing plays in maintaining trust in our financial markets.